ESG investing is a method to evaluate companies. ESG investing measures the sustainability and societal impact of a company or business. So therefore, ESG investing would be investing in a company that has good societal impact. By doing an ESG analysis, it will help people better determine the future of a business in the financial area. ESG helps small and large investors identify the risks and growths of a company in the current stock market.
What does ESG stand for? The acronym ESG stands for E, environmental, S, social, and G, governance.
E, environmental. We begin with analyzing the environmental impact of a company, both positively and negatively. This includes a company's goals for the environment, such as climate change, carbon footprint, and renewable energy used for that company. A company that has better impact on the environment may look as a better company to invest in. For example, Nike, who has fly knit and fly leather products, uses recycled materials which positively supports the environment.
S, social. Second, we look at the social component of the company. Basically, we're looking at how the company treats its members and faculty. Usually, we will take a look at the company's diversity and gender ratios. Companies who support all genders or provide insurance for their members may be a better company to invest in.
G, governance. Lastly, the corporate governance of a company shows the strength of their leaders. The governance focuses on the company's bonuses, board of directors, and how a company deals with shareholders. A company's corporate governance can be found on proxy statements on the SEC's website by searching for the filing type, DEF 14A. Usually, a strong management team and board will own shares of their own company's stocks. This shows that they believe in their company's growth and future success.
History of ESG investing. So, how did ESG begin? Over many decades, many popular investors and management groups created the shareholder value theory, which was then popularized by Milton Friedman in 1970. Shareholder value maximization puts a shareholder returns and pursuits of profit as their primary objective. Wanting profit isn't necessarily problematic. However, it could be if businesses are only concerned about making short-term profit measures to please shareholders. Companies that chase approval by shareholders rather than building relationships with the employees of their company are more likely to fail and go bankrupt. Obsessing over profit and earnings per share could cause lawsuits, investigations, and increased regulations. So, therefore, ESG came around where it didn't just focus on the profit.
Companies that do not maintain good ESG can have serious risks. Stakeholder issues related to the environment, social, and governance of a company could become a serious risk to companies, regardless of how successful it was in the past. In 2019, PG&E declared bankruptcy because of wildfires that burned up huge parts of California. PG&E didn't do anything to prevent its fires, which caused its stock price to plummet. In 2020, Tyson Foods forced an employee to work even with COVID-19 symptoms. The company also didn't practice social distancing for its employees. This is a good example of a company who doesn't pay attention to the social part of ESG. In 2016, Wells Fargo opened fake accounts, made transfers into those accounts, and assessed bank fees without authorization from customers. This shows that Wells Fargo didn't have good control of the corporate governance. These companies all failed to meet the standards of a good ESG company, which led to a lot of them being sued or going bankrupt. In conclusion, ESG is important to include in all sorts of companies.
Thanks for watching. Comment below on what you want us to do for our next video.